Hello, everybody. How's it going? Bram in the house. I'm making money. All it takes is the stock market to go up 80,000% and I can make money. I wouldn't exactly call any of this alpha, at least not the last week for me. Obviously, I think I made some, I got some good winners with catalysts over the last few months, but that ain't the reason why I'm making money these days. It's just rip roaring market. I wanted to do a YouTube because I wanted to talk mostly about ARDX. Well, I don't really know a lot about the company, so you're not going to get kind of scientific details about why I think that their AdCom is going to be positive tomorrow, but it's obviously a very topical, timely name since it's going to be halted tomorrow. There's going to be an AdCom. There's going to be a vote on 2 voting questions, I believe, and the stock can go up, 50 to 100% and down 50 to 75% after the AdCom. So let's start with that. So I talked about ARDX in the past, but the very, very brief story here is that they have a drug that they're trying to get approval for that's already approved for another indication. And everybody thought it would get approved for this. It's a rare disease where there hasn't been any kind of new treatment options for a long time. And clinicians all want this. It's very, very, very popular in the community. It was during the trials, and people were looking forward to this being available. I guess the benefit of this drug versus standard of care is it's much more convenient, and the dosing options are much, it's more infrequent. Anyway, everybody thought this was going to get approved, and it got a major amendment back in the summer of 2021, and then it got a CRL. And this is like the worst day for me to be doing YouTube. There's guys cutting trees down outside my backyard. Maisie. Yeah, I didn't know there was going to be trees being chopped down when I decided to do this YouTube, because my wife didn't tell me. So we'll see how long I have to deal with the dog barking like this. Meanwhile, they've been doing it for the last 20, 30 minutes that she hasn't barked, and now she starts barking. Anyway, they got the CRL. The FDA cited that they don't know whether or not the drug works as good or better than standard of care, I think is the idea. They wanted them to run another trial, and they appealed it to the level above the division, and they won their appeal to the extent that they said they will do an AdCom. And if the AdCom is positive, they will decide in 30 days after the AdCom whether to either approve it or to tell them to file a new NDA, which would then approve it because they don't have any new trials or any new data. And the briefing docs were released yesterday by the FDA, and it basically was as expected. There's no kind of smoking gun here from a safety perspective. Safety is totally fine. It's already approved, like I said, in other indications. And clinicians all want this. Okay. So the only question is, what is the risk benefit here? And considering the fact that clinicians are universal in wanting this in their tool set, and there is no safety issues, diarrhea is the one safety side, though my buddy tells me that's a good thing for this disease, because people are very constipated. I think that you will get a positive AdCom. I've always thought you get a positive AdCom. My thesis from months ago was that that given that the drug is in such high demand and there's no possible way for this sponsor to run another trial, the FDA, the division obviously CRL this, so they don't want to approve it. But even just judging by the AdCom questions and the briefing docs, it's reasonable to assume that the FDA set up the AdCom to vote to approve this, and then they have cover with the AdCom to then approve it based on the risk-benefit profile of the drug. So the negative on this is that they've hit the ATM huge since a year and a half ago. And as a result of the ATM, the share count is essentially doubled, or is going to double in the near term. So when the stock was 6 or 7 going into the last approval, maybe it was going to go to 8 or 9 or something. That 8 or 9 is now 4 or 5. The biotech market's also much lower, so maybe it's 3 or 4, but it's only $1.25 stock. And I think it's a decent chance the company gets sold in the next 12 months after approval. You don't have to play for any of that. I mean, basically, if you own it today, you're owning it for the AdCom tomorrow. And, it's the AdComs are total gambles. But in this scenario, given the makeup of the panel too, there seems to be a way to thread the needle here to get a positive AdCom. Given they have a bunch of clinicians on the panel, temporary members that know exactly what this drug does and who it intends to treat, and they want it for them. In theory, these people all want this drug for their clinic. So that's ARDX. I can't really answer much more than that because I don't know. I didn't even tell you what the disease is. So as you know, I know very little about biotech. For me, it's really all just about the special situation regarding major amendments or appeals or whatever. This is kind of what I've been doing the last 2 years or so, and I've been pretty successful at it. I think I've almost hit 100% hit rate, whether it's CCXI or AXSM, CTIC. Those are the 3 that come to mind right now, but all 3 of those were highly controversial and all got approved. So yeah, I don't have a big position in this at all. Right now, I'm long 2% common, and I have 2% delta adjusted in call spreads, which I'll lose like 300 basis points or so if the call spreads go to 0. So I mean, yeah, I probably have 400 basis points at risk going into tomorrow. So it's not a small position by any means from the risk perspective, but I'd make things so big that for me, it's smaller than I would normally make something. Okay. That is ARDX. Lionsgate. So remains my biggest position by far. We're sitting here again a week later since I last did this, or 2 weeks, and still no deal. The only thing I could say is it's obviously very positive that the stock market's gone up so much in the last 5 days. I mean, any metric you want to look at, whether it's comps or where the S&P 500 was in September or in August versus now, makes it enormously easier for them to sell a stake in the company or in a division in this environment than it was just 5 trading days ago or 7 days ago. The stock, if you look at the Bs, is trading at 740, and it was trading at 10 to 1050 in September and even in August when they had their language about being, very constructive on a deal. Now, they have no credibility anymore. I mean, truly no credibility. It's 6 weeks after the end of September. There's no deal. There's no reason to think they're going to get a deal. It's very, very likely they do spin off the studio. That I have complete confidence will happen. It's only whether or not the market cares or does anything before the spin actually happens if they don't consummate a transaction. But the fact you're trading at 25 to 30% below where it was in September, if they get the deal done, I think you have, potential 50% upside from here or more. And your downside is basically, I think at this point, market movements. So you could always, hedge out the market, of course, or I don't run with hedges on, but lots of people do. So if you want to hedge out the beta risk here, you could short, Warner Brothers or short Paramount against it. But I'm not doing that, and I'm not saying you should do that. But I think there's a way for you to take kind of an isolated bet on the deal now because it's not pricing in it anymore. The markets are covered and it hasn't. So, it remains by far my largest position. I'm long so many call spreads and stuff. So when it goes up, I trim my common because I'm so long gamma. Gamma is the word for when you own options. And when the stock moves up, you become more long the stock. And when the stock moves down, you become less long or short the stock. So you are rewarded for the stock moving in a sharp direction. If you're short gamma, then you are penalized for the stock moving in a sharp direction. That's the simplest way to explain it. And usually when you're long, always when you're long calls or long puts, you're long gamma. Sometimes when you're long call spreads or long put spreads, you might not be long much gamma. And if you're short, obviously those things, you're going to be short gamma. It's a rough version of how it works. So that is Lionsgate. Magnachip very quickly, massively underperforming the market and massively underperforming the semiconductor index. I told you guys last time, I am not that constructive in the near term on Magnachip. There's no reason to be, but it's really nuts. I mean, the SOX is up like 20% in November, and Magnachip is probably flat. So that all just bodes really well for eventually if they ever get their act together and we see some constructive movements in their business, or potentially, obviously, there could be a sale at any point. But I don't think will happen. I'm under 10% of that happening in the next 3 to 6 months now. It'll have massive upside because you're having the sector move and it's not moving with it. So anyway, Magnachip sucks, but it's Magnachip. I want to talk about NCR briefly. So I made NCR, again, a pretty big position. I've talked about it in the last few YouTubes, I think. Engage Capital, which is the activist that's on the board, it's one of their biggest positions. And they added, I think, 20% more shares last week. They bought 800,000 shares or something, and they owned, I think, like 4 million before that. This comes on the heels of Engage Capital bringing in one of their friends who's a former investment banker to be independent board chair. And they gave him a $250,000 signing bonus to come in. And he also gets his normal board comp. And I mean, this guy is a closer. That's what his job is. He does investment banking. He's done investment banking his whole life. So Engage was on the board of the strategic committee. And they know everything about the bids and everything that happened. And them buying stock is hugely bullish, right? They're restricted when they're in the middle of the process, and they're restricted often, or even when they're not. They only can buy or sell quarterly, and clearly the only way they're getting out of this position is through a sale. They're on the board, so they can't. If they started selling in the open market at the 20s or even in the 30s, the stock would tank. It would mean that there's no sale coming and that the activist has given up on the position. They're doing the opposite. They're putting more money into it. And, I strongly believe that in 2023, this will be sold anywhere from, $35 to $45 a share is my guess. If it's not sold, you'll have the spin, and a division will be sold, shortly after the spin is my guess. I really like NCR. I like it for a year hold. I love having the activist on the board and owning so much stock to where it's so material to their fund, and then adding now on this break. I mean, usually on a break like this, for him to put more money into it, he's seen all the bids, and I'm almost certain that the bid from I think it was Vista. I can't remember who the last final bidder was. Was in the 40s, and they just didn't buy it because the credit markets seized up. So, and the environment we have right now is massively better than it was in July and August. Well, it's better. I should say it's massively better. So I'm not expecting a sale tomorrow. Clearly not, right? They just bought stock. There it is, Capital. Thanks. They just bought stock, and there's no restricted. They're not restricted. So, but I think it could happen as soon as the spring. These things can come together pretty quickly. I mean, if Veritas can get financing, they can call up the board and say, we're interested in buying you again at $40 a share. Are you interested in selling? I can't believe the stock's $23, basically. It's the same thing I said back when it blew up in the first place. And it was about this level, maybe 22, 23. I think it should be in the upper 20s. I think it's very mispriced. And I own a ton of spreads. You name the month and the strike, I have them. I own April 28 33s. I own June 28 33s. I'm big in that. I own October 28 33s and October 30 35s. And then I'm really big in January 24s, 30-35s. And I own Jan 25, 30-35s, but you can't put those on anymore. It's too illiquid. So I plan on holding this, really, the stock would have to get into the 30s for me to sell the common. And then I'd obviously would hold the spreads for conclusion. But absent, just a disastrous quarter. And, there's two sides of this business. So even if one side ends up underperforming a little bit, there's such value here, you should be fine with the sum of the parts still being significantly more than it's trading at right now. So it would take a lot for me to kind of get dislocated from here. I like it. I like it a lot. The other stock that I have bought now, I talked about it last YouTube, but now I own it, is IAC. And I've made that a core position. Though, again, the biggest positions by far are Lionsgate and Magnachip. Lionsgate much bigger than Magnachip. IAC is truly fascinating to me. Okay, this has been a company that the smart value crowd, I guess it's more like a tech stock, I guess, whatever. The smart hedge fund crowd has always loved this name, and it's been just left for death now. And as a result of it going down so much, its discount to some of the parts is probably the highest it's ever been, or close to the highest it's ever been. So it's a very simple story. For something that has a lot of parts in it, it's a very simple story, okay? Their biggest part positions in IAC is MGM, which I'm going to talk about in detail. They own over $2 billion in stock in MGM, and the market cap in IAC is only like $4.5 billion. So call it roughly half of the market cap of IAC is you buying MGM stock. Okay, so you have to like MGM to buy IAC. Okay, the second asset that is by far the biggest is not traded. It's Dotdash Meredith, which is the culmination of the merger. They bought Meredith MDP last year. I was involved in that, or ARB2. And they combining it with their Dotdash business. And they basically own dozens of media properties that are like Home and Garden and stuff like that. And up until this kind of ad recession we've had in the last, few months, and general weakness in the ad market, this business was humming along, growing the digital business at double digits. And Dotdash had a really good track record of buying assets, putting them into the Dotdash platform, and creating all sorts of synergies and value. They fucked up pretty bad with Meredith. So this combined company was supposed to do $450 million in EBITDA next year and $300+ million this year. And they're only going to do like 250 now this year. And that 450 number is, a 2024 kind of goal. This business went from being worth, the street was probably putting, let's say, like a 13 or 14 EBITDA multiple on that 450 million. So maybe they were, I don't know, valuing it at $5-6 billion, and they paid like 2.5 or 3 billion just for Meredith. So let's call it 5 billion they were valuing at. Today, if you look at sell side notes, they're valuing the business at anywhere from 1.5 to 2.5 billion. I think it's worth well more than that. Okay, but you have to get comfortable that there's a real business there, that they can stabilize it and they can grow it. And if that gets stabilized, which it certainly will, these are not melting ice cube businesses. Though I guess someone could argue that their portfolio of websites could turn into like a MySpace, but I don't see that happening. I don't think that will happen. I think that business, that Dotdash Meredith business, is worth well over $3 billion, well over a kind of a 10 times EBITDA multiple of next year. And we can use 3 billion if you want. So you take 3 billion there, you take I think the MGM stake is worth, I'm sorry, this is what I do. I'm not very deep. When I buy stocks, my analysis is very broad strokes. I'm not trying to play for like 5, 10, 20% moves. So for me, I don't have to memorize or know the exact value of each of these things because it's just so inexpensive. So I think the MGM stake's worth like 2.5 or 2.25 billion. You put those two together, you're at well north of $5 billion in value versus a $4.5 billion market cap. And I believe net debt is just a few $100 million in the company. They have a ton of cash, but they have debt that was associated with the Meredith purchase. So I don't have it in front of me. Actually, I'll pull it up right here. I know how to get it. Hold on one second. You know, when you pay for nothing for these YouTubes, this is the kind of analysis you get. Very sloppy. I don't have any kind of notes in front of me. Dotdash Meredith has 1.5 billion in debt. Thank you, Paul. Which I guess is important because they could bankrupt Dotdash Meredith if they had to, and that debt would not go to Interactive Corp. But I'm just consolidating. I'll consolidate it all, just because that makes more sense to me to make it easier to understand. They had 300 million in net debt. If I'm looking at this right, 300 million in net cash. It doesn't really matter. It's a very little net cash or net debt. So basically, when you're paying 4.5 billion for those two assets, MGM at cost, at market right now, and what I think is a very low multiple on Dotdash Meredith. What are you getting in addition to that? You're getting a lot of shit, okay? And I think both those businesses, I'm going to go back and talk about MGM in a second, but I think both those businesses have tremendous upside. So to follow through with Dotdash Meredith, I do think they could get to the 400+ million EBITDA level, and the market will put a low double-digit EBITDA multiple on it, and you will get a $5 billion valuation versus the 2.5 or 3 that I'm using right now. And again, that is not what it's being valued at in the market. Okay, I'm going to keep adding more parts for you, and you can decide which parts are being placed, what value. The other big thing that they have is Angie's List, which has been a disaster. And the good news here is that's not worth much anymore. So their stake in Angie's List is like about $1 billion, and they own 85% of it. And the odds that they incinerate a lot of capital there is low. Maybe they burn through another few $100 million if it doesn't work. I think Angie's List can very much work. It's very different than Groupon, okay? I have a lot of... Angie's has 500 million in debt, Paul, but I'm consolidating it. I'm looking at their letter, and they show 300 million of net cash, or net debt, 300 million net debt, sorry, consolidated across Dotdash Meredith, Angie, and the holding company. So altogether, it all washes itself out. Angie's List is serving a function. They just can't figure out how to make it work for both the small technicality. They can't figure out how to make it work for the user to not have to pay well above market for the services, and then also getting enough scale of supply from the services side, and then knowing how to charge appropriately so they don't take too much of the take from the local plumbers, AC, repairman, whatever. I've used Angie's List. I don't go to it regularly. When I used it to get a new AC and heater, and I think I overpaid by like at least 25% by doing it. So it was a luxury to use them as my kind of general contractor to get me someone to do this, and it went very well. But I could see why people would have hesitancy to do that when you could save money doing it directly. So they have to figure out the best way to make this market work. There is really no great competition for it. Yelp would be the closest thing, I guess, where you go on and you search for plumbers and stuff like that. But I really do believe Angie's List can work. And the best part is you're not paying for any of it, right? So that's $1 billion, okay? The next asset that I really like, and we use all the time in this family, is QURE.com. They bought that it was a public company. They bought it a couple of years ago for like 600 million, I think, or 700 million. And that is exactly what it sounds like. You hire nannies through it. And they also have a payroll system. They have some competition in the payroll system, which I used we had a full-time nanny before our boys went into school. But there are other services that offer this. We chose to use them because we thought it was probably the most professional. But the monopoly they have is in the hiring of nannies. There really is no other place to find nannies outside of maybe a Facebook group. And it's kind of hard to see how they get dislocated there. And they've already grown the business, I think 70% since they bought it. I think that business is worth well over $1 billion, well over $1 billion. And I wouldn't want them to monetize it at all right now. I would want them to keep growing it, make it into a behemoth, and then eventually spin it out again. So very bullish on QURE.com. That's another $1 billion. They own a stake in Turo, which is a car service where you can, it's ride sharing, but what do you call it? Car sharing marketplace, where I guess like if I want to like rent my car out to a neighbor, they can, take it from me. I don't think there's anybody else doing anything like that. So I think that's again, a leader in a monopoly. I think people think that business is worth over $1 billion, well over $1 billion. They own 27% of it, and they own a warrant for 10% more. I don't know what that's worth. $500 million, $1 billion. I have no idea. They own a stake in Vivian Health. They own 75% of this, which was valued at $400 million in April. And it's not remotely impaired. It was growing like, I don't even know what they said, 50% plus last month, year over year. It's just it's a marketplace where you find health jobs, I believe, which again is like a unique niche thing that should be very, very valuable. They have a search business where they make 100 million in EBITDA every year, and they just keep making it. It just shoots out $100 million in cash. What's that worth? 500 million, $1 billion? I don't know. And then finally, they have something called the Mosaic Group, which is a mobile app platform with over 3.5 million paying subscribers that did 193 million of profitable revenue in the last 12 months. Is that worth 2, 3 times, 4 times revenue? Probably. You add up all that, the stock price doubles today. With Dotdash Meredith being worth a conservative amount, I told you, MGM being worth at current market, with QURE.com being worth just $1 billion, with Angie only being worth $1 billion. Oh my gosh, I think Daniel, I think you're right. I think they have owned SGs for the last 25 years. Yeah, the Interactive Corp has been around forever, this company. There's a huge history with this thing. Going back, you can spend a long time reading about it. It's they have a history of spinning out tons of businesses, some successful, some disasters. There's a huge history here. So the stock doubles. Okay. Now, to not lose money here, all you need is for MGM to work or to not go down, for QURE.com to be worth that $1 billion that I'm confident it will be worth, and it will grow. And then you're already at $3 billion there, by the way, or $3.5 billion. You just need another $1 billion and the rest to not lose money. That's valuing Dotdash Meredith at zero. At zero. That's valuing Turo at zero. That's valuing Angie's List at zero. That's valuing Search at zero. And that's valuing the Mosaic Group at zero. Okay. But the really interesting thing that's happened is that MGM and Interactive Corp have been buying back a shitload of their own stock. And Interactive Corp has also been buying, they're not even called Interactive Corp anymore. I think they're just called IAC. I think they used to be called Interactive Corp. That IAC, hold on, I'll get to that in a second, Paul. IAC has been buying back MGM stock, and MGM has been buying up MGM stock. If you look at the last 2 quarterly conference calls for MGM, you'll be amazed at the amount of stock they're buying back. They've bought back 30-something% of their outstanding shares since the beginning of 2021. 30+% of the outstanding shares, okay? Interactive Corp, IAC, wasn't being that aggressive on their own stock. They bought back a little over 1 million shares through September 30th. But if you go to the 10Q that just was filed last week, you'll see the share count went down another 1 million shares in the month of October. So they bought back 1 million shares just in the month of October, when previously they only bought back 1 million shares the entire 9 months. They can do math, okay? It's ridiculous how cheap this stock is, okay? And MGM is shrinking their share count so aggressively that MGM stock almost has to go up in the next 12 months if they keep this up, because it's so accretive what they're doing. He explains why they're doing it. If you back out their stake in Macau, which is currently very impaired, so if you just use what it's trading at, their stake in Macau, MGM Macau, and you back out, I think their cash, I can't remember what else he backs out. You're buying the casinos. Oh, you back out the sale. They have pending sales. They've sold the Mirage and they sold another asset. They have pending sales. The entire business is only being valued at 5 times EBITDA. Oh, Glenn, that's basically what I'm explaining right now. MGM's crazy cheap. So I think you're basically paying like 5 or 6 times EBITDA for their casinos. I have a long history with the casino business. I grew up in Las Vegas, and my family was in the casino business. And you know, they own some of the best assets there are, whether it's on Las Vegas Strip or it's regional. And they're selling assets at 16, 17 times EBITDA, and their business now is trading at 5, 6 times EBITDA. And their bet MGM stake is being valued at 0. So you're paying nothing for the online gaming portion. So there's a good reason to think that MGM in itself is a very good buy. Okay. And I definitely wouldn't hedge out MGM. I like owning MGM. I can't find many stocks that have bought back 35% of their outstanding shares in the last 2 years. And I love that that's the anchor here. You know, that makes your margin of safety so strong. And I think you'll see that stock go up materially over the next 12 to 18 months, which will then help IAC. So, yeah, I guess I'm just shocked at the opportunity there. The market has penalized it for missing the Dotdash Meredith numbers. Angie's List has been a disaster. So you've had the stock go from 10 to 2, which took it down, $3 or $4 billion in value at IAC. It's a huge amount of market cap, right? And that's been the main crux of the destruction. And those 2 assets, Angie's List and Dotdash Meredith, were the largest values at IAC. So now it's the opposite. Now they're being worth almost nothing in the sum of the parts, and they both have a chance of being worth a huge amount of money in the coming years. So Paul asked about their adjusted EBITDA adjustments. Honestly, I haven't even looked at their cash flow statements or their earnings, Paul. I'm approaching this at a much larger scale. Either you believe Dotdash Meredith has a cash flowing profitable business, or you think that they're playing with numbers. There's a huge amount of restructuring costs going on right now. So clearly there should be a lot adjusted to that. I think overall stock-based comp in the company is probably not egregious. They probably were given a lot of money in annual kind of or multi-year grants. And, I assume most of the adjustment is coming from restructurings, but that's the best answer I can give you without being a paid analyst that can actually give you a granular answer. But I haven't even looked at their income statements. It's too confusing. I don't know what QURE.com is probably not even profitable. So it doesn't really bother me that much. Does the market always slap a discount on these sort of entities? Should always trade some discount at some of the parts? It's a great question. So, when Dell owned its stake into VMW, it had a huge discount at some of the parts. I've talked about VMW and Dell a lot on this podcast over the years. And as soon as they spun VMW, some of the parts is over. The beauty with Interactive Corp, IAC, is these people are geniuses with crystallizing the value, right? I wouldn't want them to spin any of these things right now, and they're not going to. But they always spin out the businesses when they get mature. So I am certain that Dotdash Meredith will be spun out at some point. There's no reason for them to keep it in the business. Whether that's in 2024 or 2023, probably more likely 2024, okay? If that's worth $5 billion, the market has to crystallize that value when it gets spun out. The other businesses, it's all the same thing, okay? I don't know what their end game is in MGM. They've never bought a position like this before. But obviously, if that becomes a gigantic, $5, $6, $7 billion position, they could sell some of it in the open market. I don't think MGM is going to get acquired. It's too big. So I don't know what their end game is there. I don't really care. That one is the hardest one to exit. They could spin off the equity to shareholders. I don't know how that would work from a tax perspective, but that's one way they could do it. But the other businesses, QURE.com, Angie's List, all those things will be spun out at some point. Okay, Angie's might fail. Angie's List might fail. But if it does end up working, you'll have your stake in Angie's List. And the same thing with QURE.com. Same, Vivian Health, Toro, they'll sell those businesses. This is just how they operate. So they are completely incentivized to crystallize the value at the sum of the parts level. But I would not own it if I thought that tomorrow, only for tomorrow, for it to collapse some of the parts. The beauty of this is that your sum of the parts is so extreme, and I'm bullish on all the underlying businesses. I like all these businesses. They're all leaders in a marketplace that is very hard to, take off its perch. And that's what they like to do. They're all about marketplaces and flywheels and all that bullshit. So I plan on owning this one for a while. And yes, it's unlike most of my shitcos. This one actually, I think, has a real margin of safety, and I think should work for me as MGM buys back stock and as IAC buys back stock. So I spent a lot of time on that one, but I think you should dig into it, read the letters, look at the individual businesses. I think you'll come to the same conclusion that I'm coming to, which is that this should be trading in the 70s, not far off to where it's trading right now, not 51.70. So with that, I just own common. I didn't find any interesting spreads to put on. What else is left here? Unicure, QURE. They have a PDUFA next week. If they get approval, I think it'll go up, 5 to 20%. If they get a CRL, it can go down 50%. So, it's very asymmetric in the bad way going into the PDUFA. But there's been no deficiency letter, and we've had no major amendment yet. So I think the chances of approval are very high. We know that the EU certified their manufacturing facility, so the odds that there's any problem with manufacturing are almost zero. And to me, the data is very clean. So I'm very bullish on Unicure going into the PDUFA next week. What else? TRQ. I put on a little position on this again. The situation with TRQ is that the country of Canada has decided that it's not fair the way they're handling minority investors here. Just to give you a very short recap, they came to an agreement with the activist Pentwater and another activist, Sailing Stone, I think, that they are going to dissent. All public shareholders are going to get 43 Canadian a share, but the activists are going to get like $33 Canadian a share. They're going to hold back the other 20% of it. They're going to dissent. They're going to have an arbitrator decide whether it's worth more than 43 or less than 43, and that's that. And they weren't going to give this option to minority shareholders, only to the activists. Canada has come out and said that you can't do that. So it's now been like 10 days or 8 days, and they're negotiating with the independent committee to try to come up with a solution that Canada will be okay with. The most likely outcome here is that they give the same rights to all shareholders, which probably wouldn't even matter because most shareholders are going to take the 43 and not going to take the 33 plus the 20% holdback. There is a small chance that they just bump the cash amount for everybody and they move on. So we get more than 43. I put that at 1 or 2%. But there is a chance that they tell Pentwater that they will not offer this to everybody, that if you guys want to dissent, that's fine, but you do not get your $33 in cash up front. You have to do it just like everybody else has to do it, which is dissent, go to arbitration, and you'll get your money after the arbitration's done. Pentwater could say no, pound sand, and the deal completely breaks, and it goes to $20 a share. So $20 US. So this is kind of like picking up pennies in front of a steamroller. I just think that it's overwhelmingly likely that they come to an agreement with the board, because they've already come to terms with what they need to do with the activist. The activist is going to dissent, and they just have to figure out a way to either make the minority shareholders be able to participate with the activists, which most won't, so it won't matter, or tell the activists, you can still dissent, you'll still get the same amount of money you're going to get anyway, you're just not going to get it up front. You're going to get it later on, in fact. I don't think Pentwater is going to blow up their whole year by saying go pound sand. You know, we want to turn this deal down, and it's going to go $20. It's trading 41.50 Canadian, and it's worth 43. So what I did was I bought the US ADR. It's 31.30, but I hedged out all the Canadian dollar. So I'm not long the Canadian dollar currently. It's fully hedged out. Look, there's not a lot of upside here. You know, it's $1.50 Canadian on a 41.50 stock. So whatever that is, 4%. And there's, 50% downside. So it's pricing in a 90+% chance of this working. I could totally see why people would not want anything to do with this. But anyway, I own it. So I'm happy I just remembered. Somebody posted a really great note on Lionsgate on my YouTube page. And let me read it to you guys. The crux of the note is, I don't have to read you the whole thing basically, but I just want to see exactly what he said here. It basically says, if I frame bear case, what can go wrong? On the studio side, you could argue there's no strategic buyers for studio in the near term. So looking at a minority investment from a private equity firm. Debt financing environment is tough, and streaming wars headlines everywhere. See Disney dropping on results. So PE has to explain to their LPs why they're wading into the fight via minority position alongside terrible management. Then ability to sell entire biz down the line is surely complicated by introducing the minority PE today. Those guys are going to ask for strings, etc. Ideally, you would sell 100% today. The whole concept of minority is a plan B. So kind of requires some mental gymnastics to buy today on a thesis of a full exit, while accepting they're currently unable to deliver a full exit. Okay, it's a really great point. That's the first half of what he wrote. So my understanding is the reason why they're not selling today is not because nobody would buy the studio or the library today. It's that because the sum of the parts is masked in this publicly traded vehicle, they can't get the kind of premium they want to get for the studio and the library. They think the studio and the library is worth in the 20s a share, really. So it's trading at 7. So clearly they're not going to be able to sell the studio for $20 a share for trading at 7. It's just not possible. So in their minds, rightly or wrongly, they think once they split the businesses up and they publicly trade separately, hopefully with an anchor investor on each or one or the other, it then trades to a more normal valuation because the studio is not being albatrossed by stars. Think of it like a bank where there's bad debt involved, or like mortgage debt that's part of the financial crisis, and you want to spin off the bad debt into bad co or shit co, and you want to keep good co. And you're hoping that when they're split off, bad co still has a valuation, but instead of it having a negative valuation in the consolidated company, now you have a positive valuation, and then good co can trade on its own. Okay. Amazing. The very simple explanation of how this would work is it's not hard to see the studio being worth $5 billion, the studio and library. Okay. All that is a like 10 times EBITDA multiple, X synergies to a sale. Okay. They should easily be able to generate over $500 million of EBITDA post a sale to a strategic buyer. It might even be $600 million EBITDA. Okay. But let's just use the 5 billion number. If you get 5 billion in the studio side and you have $1 billion of debt on that, that's a $4 billion equity market cap. Okay. On something now that's a $1.7 billion market cap. Your stock would go up, is worth over 150% more. And those are not aggressive numbers. It's a 10 times EBITDA number post synergies on a conservative EBITDA number. Okay. Then on the stars side, if you assume that's a 0, that's fine. The debt goes away. The billion of debt goes over there. The equity is worthless and it's a 0. But if you talk to management, I mean, they're going to do 150 million of EBITDA this year at Stars, and it should go, or 120 million, and it should grow to 250 million next year. And the only way they get there is through cutting the international losses. They're not counting on any kind of Herculean subscriber growth. They are going to grow subscribers, but it's mostly just the international losses going away. So that's worth something. It's hard. It is hard. That's his next question. He talks about, stars not having any value, whatever. It's not hard to understand how stars could have value. It's harder to understand who would buy them, right? Netflix isn't going to buy stars and like fold it into Netflix. It's more likely that you're going to have to create a niche brand, which is for the African-American and female African-American community. And eventually Netflix, Disney, whatever, can offer this Stars product for a $5 a month add-on. Netflix and Disney get $250. Stars gets $250. It's all free cash flow to Stars. And you just kind of have a nice business, a nice business that's doing 300 or even 400 million of EBITDA a few years from now. And it's not impossible to see that happen. And then that business is worth $3, $4, $5 billion. Okay. I'm not counting on Stars being worth anything. I'm counting on it being worth 1.5 billion EV, which would just be a $500 million market cap post spin. And I think it would trade at that because you have all the optionality I just described, whether strategic takes them out or whatever. So the reason why you're not getting a sale today, I don't think you should assume it's because no one wants to buy either side, especially the studio or the library. It's because it's so cheap, the stock, that no strategic or private equity firm is going to pay 150% premium for just one side of the business, right? You have to do this in steps. And as the steps are done, I think you should get that payoff. Now, do you hold it all the way through the spin and the ultimate sales? It really depends on what they do with the strategic transaction. If they get a good transaction done, I think there's a lot to be said about holding it for the next 6 to 12 months. You have an amazing slate coming out next year with the first Hunger Games movie in 10 years, in John Wick, coming out in March. And, retail loves this shit. So, with good movies coming out and good box office results or whatever. And it should also provide a huge tailwind to the studio business. So, it's not a bad business. I just read yesterday that Seth Rogen has a new TV show coming out on Apple TV that Lionsgate's producing. That could be, he's starring in it. That could be incredibly, popular. So they have a real TV production business and a real motion picture production business, and it has value outside of the library value. The library value does 750 million in revenues a year, spits out 275, $300 million of cash flow a year. And, that is being refreshed now by these new movies that are coming out. I think the company's very misunderstood. It's been very poorly managed. They should never have bought Stars. They burned billions of dollars by buying Stars. And it's kind of similar like IAC in a way. If you own this, when they bought Stars, you lit money on fire. Well, now Stars has almost no value embedded in it. It's negative value, actually. It's very negative value if you put $1 billion in debt on Stars, right? And did the market go down? What happened? Oh, crap. Why did the market just start collapsing? Did Russia drop a nuclear bomb? I'm only partially kidding, by the way. That's a gigantic swing in the market to do that. Not good. Now I'm going to be distracted while we talk. So that's my answer with LGF, is that there's all sorts of missiles hits Poland. No way. Really? Misleading hits Poland? I don't know what that. Did you mean to write missiles? The news hasn't picked it up yet. Initial unconfirmed report says 1 or 2 Russian militias that lost way fell near the Ukraine border in Poland. There's an emergency meeting of the Committee of National Defense. Breaking, the report that a Russian missile intended for Ukraine crossed into Poland, killing 2 people. All right, well, that's not good, but I don't think that's going to create World War III. I don't think NATO is going to retaliate now and bomb Russia over that happening. But that's bad, but the market's stabilizing. Anyway, that's what happened. We might be going to World War III. Anyway, back to Lionsgate. No, I'm kidding. But that's the opportunity of Lionsgate. Okay, by splitting the businesses apart, you have to value Shitco, and Shitco is stars. And if you just value it $1.5 billion, the studio has to go up a lot. The stock has to double basically, and I see a clear path to that happening, or else I wouldn't be so big in it. And I like it. I like it a lot, even though I'm super disappointed with how they've handled this, how management's handled this. Any other questions? Calv. I don't own Calv for myself, Yuri. I own it in my family account. You know, I don't have a huge. I'm not in love with it. You know, I bought a lot of it after it blew up. It's trading at no EV right now. I don't know enough about their phase 3 asset to know whether it has any real value if it gets approved. I still think it's likely the company is sold, given that they're going to need cash, and I doubt they're going to do an offering at these levels. So the best way to do that is to sell. But it remains to be seen if anybody wants to buy it, because maybe that asset is not very valuable. So I'm fine with Calv, but I definitely wouldn't be jumping up in joy to be putting in new money in there. Personal opinion. I don't own Cano anymore, CANO. I sold it a few weeks ago for a big loss. Oh, he just asked about Paul. I sold it, Paul, for a loss after the Humana and CVS earnings calls. I wasn't convinced that I was pretty positive Humana wasn't going to buy them. And yeah. Unbelievable. When you're at war, anything can happen anytime. So probably only the second worst thing that a nuclear, you know, a small nuclear bomb, I don't know what I'm looking for here, suitcase nuclear bomb going off would be Russia, like a fucking idiot, hitting NATO country by accident. Morons. So we'll see what it does to the stock market, but it seems like it's ruining the day aggressively. I don't. The reason why Kano is interesting to me still, Paul, though, is I just don't understand what the exit is there. I mean, it's $2.15. They need cash. Can't they sell the business for $4 or $5 a share? Give it a huge discount to CVS and to Humana. Clearly, I was just wrong about the quality of the business, and I'm not re-entering, but I'm intrigued by it. I'm very intrigued by it. I just can't believe how wrong I was there, and I'm not in it anymore. All right, well, I'm going to watch the stock market implode and ruin my good day, though my shit stocks are still kind of hanging in there, surprisingly. But yeah, I'm going to see what's going on here with the market. And good luck tomorrow with ARDX if anybody's gambling on that. And I'll do another one of these when there's time to do one, if there's a reason to do one. Hope we see each other soon and we don't go into World War III. Everybody have a nice day, a nice week, and thanks for watching. Bye, guys.